we just rounded off the operating profit margin ratio. Okay, so let's look at our EBITDA profit ratio, known as EBITDA margin. Okay, so the earnings before interest, tax, depreciation, and amortization profit ratio is known as EBITDA margin. It's a profitability ratio that measures a company's earnings before interest, before taxes, before depreciation, and amortization. So this is going to be a tricky calculation. So I want us to follow through. And it's because the question was pimped. With the normal IFRS compliant kind of income statement, you may not have issues, but I pimped it to help us understand it better. Okay, so it provides a clearer picture of the company's operational profitability by focusing on core earnings and excluding non-operating costs. So what are the core earnings of a company? The company earns money from its direct activity, organic income, its day-to-day income. So it excludes every form of income from forex. Maybe you have investment income, you have foreign exchange gains. No, the earnings is core from the day-to-day running of the business. So that's what it focuses on. So all operational costs or non-operating costs like depreciation, amortization, taxes that you have no control over, you cannot deduct them. So it's a clearer picture of operational profitability. And the US jurisdiction loves the EBITDA very much. So what does it mean? It means it indicates how revenue is converted into operating profit, excluding the effects of interest. This one, you have no control over it. Taxes, you don't have control over taxes. Non-cash items, depreciation and amortization are non-cash items. They are just provisions. So this metric is commonly used to assess a company's operational efficiency, cash flow generation, and ability to service debts. So the earnings, the EBITDA is earnings before interest, taxes, depreciation, and amortization. This is a measure of core profitability, like I will explain, calculated adding back interest, 1, add back taxes, 2, add back depreciation, 3, and amortization to your net income. So take note of those components you are adding back when calculating this ratio. And your revenue is the normal income generated from the company, which is the first item on the S&P. Okay, so let's crack the calculation now. Let's go to the computation. This is very interesting. Okay, so let me do the first one and we'll go to the second one. So EBITDA. So let me go and start from the bottom line. I know Julie will say, why are you starting from the bottom line? But I'll show you why. So the first thing is I'll pick my profit after tax. I'll go and add it, take it as the first expense. So from the formula, it says this is a measure of core profitability calculated by adding back interest, taxes, depreciation, and amortization. So I've taken the earnings, which is the bottom line. So I'll go and add back. The first thing I have is taxes. So I'll take my tax and add it back. So tax is supposed to be negative, but I'm adding it back because it's supposed to be a walk back. We call it walk back. Okay, so I'll add back tax. Then what is the next item? I'll add back finance cost because it has been deducted. So I'll add back finance cost. Remove the negativity, I'll add back finance cost. Then I'll go to the question again, add back depreciation and amortization. So this is for depreciation. This is for amortization. Fantastic. So having added that back now, there is a problem, and it's not a problem. So take note. You have finance income. So what does finance income mean? You give out loans from somebody, as somebody is owing you debt, and the person is paying you finance income. So companies do that. They give out debt to maybe a sister company, and they charge them interest, just like you two, you collected loan and you are paying 22 million interest. So somebody paid you finance income back. So you are not going to add it back now. You are going to deduct it. You will deduct it. So this is not an addable now. Since we are working back, it's going to be a deduction. So please take note of that under exam condition. And I deliberately pimped the question because of that. So our net profit after tax is going to be your total of this, which is added back, minus your finance income. And this is your net profit after tax. So take note of the finance income in your calculation. Take note of that. Though it doesn't come regularly, but
did you say net profit after tax?
Yeah, so this profit after tax is the acronym used. So I'm just using net because I've added back and I've deducted finance income. So I just put net so that I won't still say profit after tax. So let me call it EBITDA. So this is our EBITDA.
So it's before tax now.
Huh?
It's before.
Sorry, I didn't catch that.
You said after, but it is before. Because you added it back.
Yes, I added it back. So it will now be profit before. So
exactly. Because you just said after, it's before.
Oh, okay, yes, it's before. You're correct. So
another thing, sir, question. Okay. We're removing the finance income.
Yes.
No, is it because it's not an income from the business? That's why we're removing it.
Good question. This is what I want. So now, if you look at the definition, our bottom line is 77. So this 11 added to our profit is inclusive of this profit. It's an addable. It's something that came in for us. But because the EBITDA, you are working back. So if you look at our profit, we added back this tax expense. So if you add 77 to 16, you have 86,500. If you now add 22 to 86,500, your value increases. So when it comes to this finance income, you cannot ignore it. You have to add it back. So as you are working back to derive your EBITDA, this income that came positive to the company has to be added back. Has to be deducted.
Removed.
Yes, removed. Exactly. That's the word. It has to be removed.
From other businesses, we're going to remove them too.
Yes. So any income from other businesses that has to do with maybe dividend received or discount received, you remove it since it's an income. Exactly.
Even if it's not, because it's at the bottom, even if it's at the top, we're going to remove it too, are we?
Yes, exactly. So just understand the component that, if the finance income is coming before earnings, before interest and tax. So if it's a cost, you add it back. If it's an income, you deduct it. Simple, since you are working back. It's quite complicated, but then I think it's easy, but it's not simple. Does anybody have an issue with that too? Because I know Julie will definitely catch that.
Okay.
So did you have a contrary view? Do you have an issue with this, adding back, working back? Or we are clear with it? Salma, are you okay? I notice you're having network challenge.
Also, I've been having networks. I don't know what's happening with this EBITDA.
EBITDA, okay. All right, since you are back now, Aisha, are you on the call?
I am now on the call.
Okay. And Namesake, are you there too? It's like my namesake is sleeping. Okay. So let me go back to the EBITDA again. So the EBITDA is quite a simple ratio, but it's a bit complicated. So let me go back again for clarity's sake and for Salman that was off and on. So the earnings before interest, the first earnings that we'll look at from our case here is the profit before depreciation and amortization. Julie can say, why didn't we just pick this depreciation and amortization? You won't do that because you want to understand the deductions and the additions, especially where you have finance income. If there was no finance income in this place, we will not do all the journey of working back, deduct, deduct, deduct. We'll just come to 132 and pick it as our EBITDA. But because we want to understand all these expenses that are not directly incurred in the business, they were imposed on the business, like depreciation and amortization is imposed. You must deduct it because of an IFRS provision or a company policy. Finance cost, you borrowed money, so you must pay back. Tax is money to the government, you must pay. But you see, these ones can be influenced. Admin and distribution, your cost of sales can also be influenced by your decisions. So your decision cannot influence depreciation, finance cost, finance income. That one, you borrowed money, you got a return from somebody owing you. So the EBITDA is trying to measure the direct operational efficiency and cash flow generation of the business, excluding any effects of financing, government, and non-cash item or non-cash movements. So that's what it's all about. So I started the calculation by saying that I'll add back my profit after tax. I'll pick profit after tax as the first item. Then I'll add back tax expenses, add back finance cost, add back depreciation, all the costs that I have no control over, I'll add them back. So immediately I add them back, I will have a total that is, in fact, let me even do a total here of all the expenses before I deduct. So I have 143,000. So this 143,000 now is like we even computed, my formula was wrong. So 143 is what I got after adding back all the inorganic expenses. So I now want to remove finance income because that is an income. We can't add it back. So our finance income 43 minus 11 is now going to give us 32. So if you come back here, you can see that it aligns directly with this profit before depreciation and amortization, even after we have removed finance income. So this 132 aligns practically with your EBITDA, that this is your earnings before interest, taxes, and depreciation. But sometimes the examiner may not give you this figure, and at times he may give you and say this is EBITDA, so you don't need to stress yourself, just pick the figure. But where in a situation me I picked it now and I call it profit before depreciation and amortization, please add back, work back. Pick your profit before tax, add finance cost, add depreciation, then remove finance income if there is, to arrive at your earnings before interest and tax. So do we understand that?
Okay.
Julie doesn't understand. The way she said, okay.
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 So why can't you just pick the 132 directly? Why do you have to add that?
Exactly.
And you see, so
instead of doing all the sufferings, we can just look at all the items there and say, okay, these are things that we add back. Since we already have the figure, we might as well pick it up. So
exactly. So under exam condition, if you are sharp enough because of time management and you know 32 is correct, fine. But to be very sure, so that your interpretation and your explanation will not be wrong, please walk back. Work back. But if you can pick 132 and you are clearly sure it is, it's fine. You've saved a lot of time. I'm going through this process so that you can understand the cost components. That's just why I'm letting you follow through. All right. So it's fine. So let's go now. We have overflogged this EBITDA. So let me pick my revenue. so that we can move on. So revenue is 132. Oh, okay, I already have the figure here, so let me just post it here. Okay, so 132 billion. So what is our EBITDA profit ratio, or it's called EBITDA profit, okay, or EBITDA margin? Any of these two you call it is correct. So I think it's 10%.
10% for both, for all 23 years.
Oh, fantastic. So that means their operating margin is 10%, 10%, 10%. Their EBITDA is also 10%, 10%, 10%. Wow. So operating profit, EBITDA margin, they have the same computation, the same values. Fantastic. Okay, so 10%, 10% still plateau. So the question now is, what is the difference between EBITDA and operating profit margin? So the difference is that EBITDA, you have to add back, while operating profit margin, you don't have to add back. So under exam scenarios,
That considers non-cash transactions.
Exactly, Salman, exactly. While operating profit considers only cash transactions. So under exam conditions, just take note of both ratios. They are not the same. Even if we have the same result currently in the computation, they are not the same. So let's look at the meaning so that it will give us more context, the implication. So a higher EBITDA margin indicates that the company is generating strong core profits relative to its revenue, demonstrating operational efficiency and good control over its core business, not non-core. A lower EBITDA margin suggests operational inefficiencies or high cost in limiting the company's profitability. It may be an indication that the company is struggling to manage its operating expenses, or that revenue are not being maximized. So this may be the reason for a low EBITDA. Now the cause and effect. A higher EBITDA margin shows either strong revenue growth combined with effective cost control. Operational efficiencies that reduce costs relative to production. So we're looking at direct cost, then indirect, admin, and selling. So the absence of non-large or large non-cash charges, depreciation, amortization may also boost EBITDA. So look at where this comes in now, Julie. You see the adding back of this depreciation and amortization will help boost it if the depreciation and amortization is not large. Yes. So look at what they said. It may boost EBITDA in asset-light business. So where the assets don't have high depreciation or they are not capital intensive, your EBITDA is always positive and has a positive outlook or result. So take note of that. While a lower one signals rising operational costs, the same direct labor, material, utility, without corresponding revenue growth. So this could be the challenge. While declining revenue in a highly competitive or difficult market environment, the need for significant spending on operating expenses like marketing, research and development, logistics. So where you have revenue declining, they need to expand. They need to work on doing research and coming up with new product lines or services that will boost their revenue. What are the effects? The EBITDA or a high one indicates strong cash flow because your direct or core operations brings you direct cash from revenue to direct and to indirect costs before the costs that you don't have control over, making it easier to cover interest expense, taxes, and capital expenditure. So when you have a high operating profit, a high EBITDA, it shows that, you are doing very well and you could cover most of these uncontrollable costs, or we call them inevitable cost you have no control over. And it can also increase investor confidence and suggest effective operations and robust profitability. The company may have more flexibility for expansion, reinvestments, and paying of dividend when they have a high EBITDA. While a lower EBITDA raises concerns about operational inefficiencies, rising costs. It can indicate reduced profitability, making it hard to cover fixed expenses like finance costs and capital investments. So this may cause investors to question the company's ability to sustain long-term growth and profitability. So the EBITDA is actually a long-term measure of profitability, especially in the US. It's a very serious parameter or component to measure performance. So in conclusion, it's a useful tool for assessing a company's core operational performance without the impact of non-operational or non-cash items, which are mainly depreciation and amortization. It is especially valuable for comparing companies within the same industry, as it neutralizes the effects of different financing structures or depreciation policy. So the EBITDA targets the issue of depreciation and finance costs to take them out of the picture. A strong EBITDA margin is a sign of healthy cash flows and good operational management. A declining one indicates inefficiencies or rising costs that needs to be addressed. So that's the EBITDA for you. My CEO in this office, he doesn't play with this ratio. You just ask, what is your EBITDA? What is your EBITDA? He seems to be an American. So even though it's an American ratio, the UK jurisdiction hardly aligns with it. All right, so any question on that? Any question on EBITDA?
From your description of EBITDA, I really don't know why it should be a big measure of measurement. It's a big issue of measurement because finance cost is an issue and it depletes the profit. So left to me, the net income should be the best. The net
Exactly.
should be the best. I don't know why EBITDA should be. But there's so many things involved here. You've removed very sensitive things that affect profit and affect the position of the company and also affect decision making. So why should EBITDA be the ultimate? I don't know.
Yeah, so it may not be the ultimate in the UK. Like, okay, yeah, go ahead. Let's hear your thoughts. Please speak. Yeah.
I feel because you know that for companies, it's a management concept where you're supposed to have a mixed source of income where you have debt and equity. So I feel EBITDA is just to measure, to control your debt, so that by the time your finance cost is on the high, you know that you're beginning to put too much money. You're beginning to borrow so much money, or to reduce the payout ratio. Like you're not postponing when to pay your debt. You're paying on time. I don't know. I really don't get this EBITDA. I'm just going with the flow, but I'm trying to make sense of it.
Yeah, so if you look at Julie's thoughts and her where she gravitates towards, I think I agree with her, because if you exclude those expenses you must pay, finance cost, I mean, now you are saying it's like the ultimate for the US. In her opinion, it doesn't match. I agree with her argument. But then you see, in a place where you don't even have external debt, you won't pay finance cost. So finance cost is out of your SCI. So like what Salma is of the opinion of is that the mix between equity and debt. So finance cost belongs to interest that you borrowed money from outside. But depreciation, you have no choice. If you have assets, you are running the company, you must make provision for depreciation. It's IRS compliant. It's a compliance issue. You must comply with that. You can't have assets and say the asset will stay in perpetuity at the same value. It's not possible. Assets based on accounting assumption must depreciate. So the EBITDA, according to the Americans, I think their alignment with EBITDA is that after direct and indirect cost, this is your money. This is the company's money. That's their cash.
Okay.
That's their own argument. And that's why they came up with that ratio. Then every other expense, finance cost, taxes, depreciation and amortization is not your money. You have to deduct it. So the EBITDA shows this is your money. After other expenses, it's not your money. Then the net profit is, okay, they've deducted it. So I also agree with what you said, that the net profit should be the best measure. You have deducted every expense. And that is why the UK IFRS looks at the net profit as the bottom line. That's the best. And that's the last ratio we'll be looking at. So I think it depends on your argument and your debate. And that is why the case study is good. There's no correct and there's no wrong answer. Follow the format, and the examiner will just be marking, and what Julie wrote is different from what Josiah wrote. What Josiah wrote is different from what Salma wrote. And we all pass the exam because everybody's argument is tenable depending on the jurisdiction, depending on the points, and depending on the industry or scenario where the business is based. So that's what I think is a good argument in this EBITDA, not net profit conversation.
Okay.
Salma, are you good? Are you good with the explanation? I think Julia aligns.
Yes, I'll take time and read it.
Okay, yes,
If
please.
only two of you that are in this class, I'll just take my time and read it.
You two are also in the class now. You're also contributing very, very profitably. Okay, all right, so let's go for the last, which is my best. I think, in my opinion, I prefer the net profit margin. It provides a holistic and true picture of whatever it is that is your own, actually. Okay, so let's go for the net profit margin now, and it's our final profitability ratio. Okay, so this ratio expresses a percentage or the entity's net profit as a percentage of sales or revenue. And the formula is net profit times 100 divided by your revenue. So look at this definition. Net profit margin is one of the most comprehensive profitability ratios. So EBITDA, operating profit margin, has confused you, but this is more comprehensive, and I agree with the study text. It measures the percentage of revenue that remains as net income after all expenses, including operating costs, interest, taxes, and non-operating items like depreciation have been deducted. It shows how effectively a company converts its revenue into actual profit. So EBITDA, in my opinion, is just cash flow. Cash flow is different from profit. Take note of it. Operating profit is different from actual profit. So in my opinion, measure of profitability, the net profit is a more clearer picture. So what does it mean? The net profit margin indicates the overall profitability of the company after accounting for all its expenses, whatever nature of its expenses are. It is a measure of how much the company keeps for every naira of revenue it generates. So from the first naira down to the last expense, tax, it reflects not only operational efficiency, but the impact of financing and tax strategy. So the net income is the profit remaining after all costs, including cost of goods sold, operating expenses, interest, taxes, and other expenses have been deducted. Revenue remains the same. Okay, so I believe it's the simplest ratio we will calculate. It doesn't have any complications like EBITDA, operating profit, and all that. So let's go down to the question and just happily calculate it. All right, so pick our 77, profit after tax.
That's 55.83%. Across board.
Fantastic. So let me just do one, and I'll just take Julie's calculation and do it across board. You see, it's very simple that she has even calculated everything without like that. NPM is 77 divided
like
by
Rosie. Return on capital employed.
Yes, those are the complicated ones, and those are the ones the examiner
PBIT.
likes to test. PBIT.
Of course.
The examiner
PBIT.
likes to test that always. Okay, so you said 5.1%.
5.83%.
Okay, so that's why we have approximately 6%. 2021 too, the same thing,
Across
right?
board.
Yes, so good. Salma and
Yes.
And Aisha, do you agree with Julie?
Yes, sir.
Okay, fantastic. So we all agree with 6% bottom line. Okay, so in our opinion, is that bottom line low or is high? There was 1%, there was one ratio they still had 6%. Which one? Okay, return on asset, 5. Okay. Okay. So return on asset is 5. The net profit margin is 6. So 5.83% across boards. All right. So let's go for the interpretation and what it means. So the implication is that a high net profit margin suggests a company is effectively converting, yes, we've spoken to that, demonstrating strong cost management across all areas. Operations, financing, taxes. So where the figure is positive, I think we need to give management credit. So it just now depends on their improvement. So in this situation where they are static, they are doing 6% every year. The net profit needs to grow because that's the bottom line where you get money to pay preference dividend and also share ordinary ordinary shareholders dividend also. So you should be able to grow that and make it sustainable over time. That's my own outlook in running a business. So you can't be doing 6% of your bottom line. So what will you share to people that have invested capital and wealth into the business? So it's very important that growing your net profit is good. It's essential for a business to be sustainable. A lower net profit margin may indicate expenses, whether operational, internal, external, organic, inorganic. They are having challenges with controlling these costs, wherever it is. So the company should be able to generate enough revenue to cover this expense and still have something to share out to people that have invested their resources in the company. So what are the costs and effects? A higher net profit margin shows that they are effectively curtailing costs, whether it's production, admin, financing, lower tax liabilities, favorable tax strategies, higher pricing power, increased revenue related to costs. While a lower net profit shows there's high cost, whether direct or indirect, that are not offset by revenue growth. So as revenue is growing, the net NPM, net profit, should be growing too, in my opinion. Higher financing costs like interest expense due to increased borrowing, that's debt, increased tax liabilities, and lower tax efficiencies. The effects is that where you have a high net profit, a high bottom line, there's always overall profitability and financial health. Now, the shareholders are interested in net profit because if there are preference dividend, they will give preference dividend because before they will get their own. So dividend and sharing of profit is very essential for ordinary shareholders. While the effects also provides more resources for growth, reinvestment, expansion, returning value to shareholders. I like this because these people are the owners of the business. So returning value to shareholders through dividends or share buybacks. Exactly. It improves their confidence. Also, those that want to invest would have that guts to come and invest since the company is profitable, looking at the bottom line, as it signals strong control over both costs and revenue. While a lower net profit indicates challenges in managing costs and rising competition affecting pricing. It may signal investors, stakeholders that the company has limited profitability, and this is very concerning. It shows that it's not sustainable in the long run. It limits the company's ability to invest in growth, cover fixed expenses, or handle unexpected financial difficulties. So these are the challenges of having a low NPM. So in conclusion, the NPM, in my opinion, is the overall indicator of a company's financial health and long-term sustainability. It reflects the company's ability to control both operational and non-operational costs to convert its revenue to higher or to actual profit. Now, the net profit signifies effective cost management, or a high one, while a low one indicates inefficiencies, high debt, or other financial challenges. So as chartered accountants, we need to monitor this ratio to help businesses track their bottom line performance. Very important. And make strategic decisions related to cost control and profitability. This is very clear. And in my view, this is the best ratio to measure performance and how the business is doing. I think that aligns with Julie. Julie, do you agree with this ratio?
Yeah, definitely.
You prefer it to the EBITDA.
Of course, because it shows the true position of the business before you pay your dividends.
Yes, exactly. Maybe that is why it's the last ratio that always comes last. Salma, can I hear your thoughts on this ratio?
Is there anything like profit after dividend payments?
No, not really. It's just profit after tax. So when you deduct, if you have preference dividend, you remove preference dividend, is still profit after tax. That's what is the bottom line. There's no profit after dividend payment. Once you pay dividend, that's all. So what you have is retained earnings. So if your
earnings,
so if your net profit is a particular amount and you didn't share all as dividend, the remaining goes to retained earnings. So you are retaining it for the company. Yes.
Okay, then it's called retained earnings. That is your profit after
dividend
payment.
After
retained
dividend
earnings.
Exactly.
Retained earnings. Okay.
Yes. Okay, Salma, I want to hear your thoughts on the net profit.
My thought, right now, I feel like for this net profit now, how do we even ascertain the effect? Because now we already know that, okay, for when, let's say we start from return on capital employed. Where was that one? Return on capital employed. We already know. Okay, let me even start from where we started today. Return on assets and all of that. We've already known like the net income is low because there was increase in cost of sales. So how do we still use the same implication for all of it, like in trying to interpret it?
Okay, yes. So it depends on the components of those ratios you calculated. So the implication for return on asset is different from the implication for net profit margin. So, for example, return on assets, the components are
how efficient, how the management use the assets in maximizing profit.
Exactly. So that's the implication now. You're looking at the implication of your bottom line and the asset utilization. But the net profit, you are looking at the bottom line to revenue. So the implications will be different. Your explanation is different because the components used to calculate these ratios are totally different. So the implication cannot be the same.
Okay.
Yes, it cannot be the same. So explain it based on the components you are using in the ratio calculation. So if you look at the components, it will be easy for you to speak and write or interpret the implication and the effects and your conclusion and your recommendation.
Okay. So for this Dan Cabri now,
yes,
you say that the revenue increased every year.
Yes. So you can just when you are speaking to the numbers, so you just maybe do a percentage when you are doing trade analysis. 1.3 billion. The next year it moved to 1.4. It also moved to 1.6. But don't forget their cost is also moving. Look at the cost of sales.
It's also increasing.
Yes, 1.1, 1.2, 1.3. So the cost is also moving. So as revenue is moving, is in tandem with cost too. So just like Nigeria economy, the inflation is going high, cost of living is going high, you are increasing people's salary, everything is high. So you hardly have bottom line. That's why we don't have savings. Most people don't have savings in Nigeria because everything is going in proportion with the inflation. And that's what Dan Kabir is going through too.
Yes.
Yeah, so it's very practical. I think the business, looking at how the expenses is, if the revenue is increasing and the cost is reducing, you will say management is doing very well. This business is, there's something they are doing. We should check their secret. If cost of sales dropped in 2021 to maybe 1 billion or 900 million. On 2022, it dropped to 700. The bottom line and the other components will be fantastic. Yeah, but as revenue is going up, costs too are going up. The typical Nigerian situation. Yes. Yes. So, Julie, I like Salma's thoughts. So, do you have something to add to that? I hope she's not sleeping.
I think the network went off when she was trying to explain. So I didn't really get what she said.
Okay, I got what she said. She said that looking at the business holistically and looking at the components of the ratio, when we are explaining the implications, can we explain the implications based on the ratios computed? So she said, for example, return on asset. The implication of return on assets result, looking at 5%, 5%, 5%, and that of net profit 6%, can we say is the same? And I said, no, it cannot be the same because the measure of return on asset is your profit after tax and total asset. But the measure of net profit is profit after tax and revenue. So she now said, based on Dan Kabir, that can we say that Dan Kabir's revenue is increasing? I said, yes, it's increasing, but look at your cost too. They are also increasing.
That's inclusive.
Yeah. Yes. So look at Dan Kabir now, 1.3 billion in revenue 2020. It moved to 1.4 in 2021, 1.6 2022. Look at the cost of sales, 1.1, 1.2, 1.3. Let's even look at their, let's look at their indirect expense, 55.33. It moved to 60,000,036, moved to 69.41. So the situation is not rosy for the company. As the revenue is increasing, costs are also increasing, which also affects the bottom line. So I was saying it's a typical Nigerian situation where we have inflation at a particular percentage currently. I think they are saying it's about 29%. Cost of living is going high and cost of everything. They are increasing salaries, but it's not measurable with the cost of living. So doing business is quite hard, and it's just a typical situation we are facing in the country. And it helps us interpret the businesses, and in the case study exam, we're able to bring to bear these factors. So that's just what we're expecting to. All right, so it's 10:03. We are taking 3 minutes of our time. Do we have any questions? So at least we've exhausted profitability. So I think by Monday, when we'll release pre-scene tomorrow, so maybe Monday we'll release on scene. We'll look at liquidity ratios. Then maybe on Thursday we should start solving the first mock exam. So I think Monday we should be able to conclude on liquidity ratios because we have plenty of those ratios under liquidity. Okay, so all right. So do we know any other question, right? Yeah, no questions, so that we can go and rest. It's